All right, let's dive right into this explainer and decode the Nigerian tax rulebook. Look, if you're a sole trader, an entrepreneur, or just self-employed in any capacity, understanding the Personal Income Tax Act is absolutely essential. And our goal here isn't just basic compliance. We want to understand this system so deeply that you can legally minimize your tax liability without giving yourself a headache. So we're going to look strictly at the facts, the actual legal provisions, and the completely approved methods for managing your taxes as an unincorporated entity. But before we even get into the math, the deductions, or the tax brackets, we need to stop and ask one absolutely crucial question. Are you sure you aren't running a business? I ask because under the law, you might accidentally be running a taxable business without even realizing it. The term business is defined incredibly broadly in the Act. It includes basically any trade, profession, or vocation. So if you're out there generating a surplus from an activity, well, the tax authorities might just view you as a trader. So here is our roadmap for today. 1. Are you a business? 2. The expense rulebook. 3. Mastering capital allowances. 4. Reliefs and deductions. And 5. Computing your tax. Okay, let's jump into Section 1. Are you a business? Determining your trade status under the law. So how do the authorities actually figure this out? Well, there's no single absolute test. Instead, based on the Royal Commission, they use a 6-point checklist known as the badges of trade. They basically act like financial detectives to determine if your surplus income is coming from a taxable trade. They're going to look at the frequency of your transactions, like, are you doing this repeatedly? They look at the length of ownership. Did you just buy something and immediately flip it? They'll also check out your primary motive and whether you did any supplementary work to make a property more marketable. If your activities are checking these boxes, you are very likely trading. And this perfectly illustrates the reality of the legal system. While that checklist exists as a great guide, the courts rely heavily on judicial precedent, noting that there are actually no fixed rules. Every single case has to be examined on its own facts, so context is quite literally everything. In past cases, we've seen that just because an activity generates a surplus, that doesn't automatically make it a trade. The courts will thoroughly examine the unique circumstances of every single transaction. Moving right along to Section 2, the expense rulebook, allowable versus non-allowable deductions. Okay, the crucial point to remember here is that you cannot just deduct anything you want. For an expense to be deducted from your income, it has to pass a really rigorous test. We call it the WEN test. That stands for wholly, exclusively, necessarily, and reasonably incurred. The entire amount must be borne for earning the income. It has to be exclusive to generating that specific income. You couldn't have derived the income without it, and the cost just has to make logical sense compared to standard industry practices. If an expense fails even one part of this test, it gets completely thrown out. Let's look at how this actually plays out in practice. Say you pay interest on borrowed capital that you use to acquire income. That is perfectly allowable. But your private, domestic living expenses, absolutely rejected. And furthermore, if you withdraw capital from the business or you have taxes levied on profits, those are strictly off limits for deductions. Now, here is a massive trap that a lot of business owners fall right into. You are allowed to deduct bad debts if you can prove them during the period. But, and this honestly shocks a lot of people, the tax law strictly forbids deducting standard depreciation on your non-current assets. Your accountant might be calculating it internally for your own books, but the taxman will outright reject it as an allowable expense. Which brings us nicely to Section 3, Mastering Capital Allowances, the legal alternative to depreciation. This right here is your aha moment. Since standard depreciation is completely off the table, capital allowance is the legally approved alternative. It's essentially a relief granted to a taxpayer who incurs what the law calls qualifying capital expenditure. We're talking about things like plant, machinery, fixtures, or motor vehicles that you use for the business. As long as you own the asset and it was actively in use at the end of the basis period, you can claim this allowance specifically in place of that disallowed depreciation. Depending on the actual asset and where it is in its life cycle, you're going to use a combination of 4 specific allowances to bring down your taxable profit. You have the initial allowance, which gives you immediate relief but is only claimable once. Then you have the annual allowance, claimable yearly on a straight-line basis over the asset's useful life. There's also an investment allowance, which is a one-time 10% incentive specifically just for plant and machinery. And finally, when you dispose of the asset, you calculate a balancing adjustment, which could result in a further allowance or a charge, depending on your sale price versus the written down value.
All right, on to Section 4, Reliefs and Deductions, legally lowering your tax liability.
So, beyond the strict business expenses and those asset allowances, the government actually generously rewards you for protecting your personal future. Every single naira you put into these specific approved schemes is legally shielded from the taxman. This includes your 2.5% contribution to the National Housing Fund, your payments into the National Health Insurance Scheme, and the premiums you pay for life assurance on yourself or your spouse. It also fully exempts your contributions to the National Pension Scheme, which sits at a minimum of 8% of your monthly emolument. If you're paying into these safety nets, you just subtract them directly from your taxable income. And on top of those specific exemptions, you get what's called the Consolidated Relief Allowance, or the CRA. Think of this as a powerful automatic deduction calculation that further slashes your taxable base. The law basically grants you the higher of either 200,000 naira or 1% of your gross income. And then it adds a flat 20% of your gross income right on top of that. This is a massive relief, and it's specifically designed to ensure a significant chunk of your earnings goes completely untaxed. We're almost there. Section 5, Computing Your Tax, Defeating the Final Boss. When you're doing this, please don't stare at the whole profit and loss statement at once. It's just overwhelming. Just follow these 4 sequential steps. First, determine your gross income by taking your total profits and subtracting any non-taxable income and those allowable business expenses. Second, subtract your personal reliefs and tax-exempt deductions, like the pension and that CRA we just talked about. Step 3 arrives at your chargeable income, which is really the only number the taxman cares about. And finally, you just apply the tax brackets to find your liability. So once you have that chargeable income number, you literally just slice it up and run it through these tiered brackets. Because Nigeria uses a progressive tax system, you're only paying 7% on the first 300,000 naira, 11% on the next 300,000, and so on, stepping up incrementally. You only ever pay the highest rate of 24% on the portion of your chargeable income that actually exceeds 3.2 million naira. But hold on, you need to be aware of this absolutely crucial provision. Let's say you're a total master at this. Your business expenses, your capital allowances, and those massive personal reliefs completely wipe out your chargeable income entirely. Well, you might still be caught by the minimum tax provision. The law states that if you have zero chargeable income, or if your computed tax ends up being less than 1% of your total income, you are automatically charged a flat 1% of your total income anyway. Now, the only exception, which was introduced recently, is if you earn the national minimum wage or less. In that specific case, you're exempt from this minimum tax. And guys, you absolutely must get this right, because the stakes are incredibly high here. According to Section 94 of the Act, failing to comply with the rules carries some really heavy penalties. Making false statements or keeping false returns just to evade tax, that can land you a 50,000 naira fine as an individual, or worse, up to 6 months in prison. Or, if you just make an incorrect return by omitting some income, you could be fined 20,000 naira, plus double the amount of tax you undercharged. The law absolutely demands precision and honesty. So we've walked through the badges of trade, the incredibly strict WENR expense rules, your capital allowances, your personal reliefs, and those progressive tax brackets. Now that you understand exactly how the law views your sole proprietorship, take a really hard look at your financial records. If the tax authority knocked on your door tomorrow, are your books truly ready?